So gold's doing something right now that we haven't seen since the 1970s. And honestly, most people have no idea what's really coming next. And let me tell you, this is not just some random rally. This move has a playbook. It has phases, 3 of them to be exact, and we're barely in phase 1. So let's dive in.
Okay, so here's the big puzzle, the central question. Why is gold soaring when interest rates are this high? Every financial textbook on the planet tells you that this shouldn't be happening. When rates go up, gold is supposed to take a hit. So what is going on here? How is it defying what we think of as financial gravity?
Yeah, so forget about this being some short-term blip. The core idea here, the big takeaway, is that we're watching the very early stages of a fundamental, long-term shift in the entire global financial system. It's what the source calls a structural repricing, and it's going to unfold in 3 very distinct phases.
All right, to really get what's happening, we've got to rewind a bit. This entire bull market didn't start with some inflation report or market speculation. No, this whole thing was kicked off by one single geopolitical event that completely changed the rules of the game. And here it is, February 2022. The US and its allies freeze Russia's foreign currency reserves. Now look, for this analysis, the politics behind that decision, that's not the point. What matters? What changed everything was the financial consequence of that action.
You see, that one move sent this massive ripple effect across the entire globe. It basically forced every central bank, every sovereign wealth fund, every big money manager on the planet to hit the brakes and question decades of assumptions about how the financial world works.
And it all came down to one single question that every country's leadership had to ask themselves. Hey, if their reserves can be frozen, what's to stop that from happening to us? All of a sudden, for the first time in a generation, just holding US dollar assets was no longer seen as a completely risk-free choice.
And just so we're all on the same page, a reserve asset, that's the bedrock of a country's entire financial system. For decades, U.S. Treasury bonds were the undisputed champion, the foundation of global finance. The moment that trust got shaky, the whole game changed. It forced these huge institutions to start looking for an alternative.
Okay, so where do we go from here? How do we make sense of all this? Well, the source material gives us a super clear 3-phase framework. You can think of it as a roadmap to help us understand where we've been, where we are right now, and where this whole thing could be going.
So, here's the breakdown. Phase 1, reserve rotation. That's the quiet accumulation by central banks, and it's where we are today. Phase 2 is what we'll call forced money printing. That's when the Fed's hand is forced. And Phase 3, the potential endgame, the bond market spiral. And here's the key takeaways. We're still in the quiet part. This is just the beginning.
All right, phase 1. This is what's happening right now under the surface. This isn't your average investor jumping on a trend. No, this price action is being driven by the quiet, methodical, large-scale buying from central banks and other sovereign institutions. They're diversifying away from the dollar, they're moving in huge size, and they're doing it as quietly as possible. Phase 2, well, that's when things start to get a lot less quiet. It kicks off when something in the financial system, breaks. When the stress gets so bad that the Federal Reserve is forced to prioritize financial stability over everything else. And I'm using the word forced because, believe me, it won't be a choice they want to make.
And that's because the Fed is staring down what you could call impossible math. On one hand, they need to keep interest rates low enough to handle the massive U.S. government debt. But on the other hand, they say they want to shrink their balance sheet and bring back some discipline. The problem is, you just can't do both at the same time. Eventually, something's got to give. And this impossible choice, well, it leads directly to what some call a nightmare loop. As the government borrows more, it has to issue more bonds. That pushes interest costs up, which makes the deficit even bigger, which means they have to borrow even more. You see how the cycle just feeds on itself? It's a really nasty trap.
And that brings us to the potential endgame, phase 3, the bond market death spiral. Think of it like this. The government has to sell bonds to fund itself, right? But suddenly, private buyers start to back away, worried they'll get paid back with money that's worth a lot less. So to keep interest rates from skyrocketing and crashing everything, who steps in? The central bank. They have no choice but to print money and buy up all that debt nobody else wants. And that's when confidence really starts to erode in a very visible way.
Okay, but here's a twist. There's a wild card in all of this, a critical variable that could dramatically speed up the jump from this quiet phase 1 to the much more chaotic phase 2. And that wild card is oil. Think about it. Oil is literally an input cost for, well, pretty much everything. So if you get a big oil price shock, that impossible math for the Fed, it becomes flat out unsolvable. It pushes inflation up while slowing the economy down, backing them into a corner with no good options. And historically, as you can see, these major oil shocks often act like rocket fuel for gold, because they expose just how fragile the whole system is. So as this whole story unfolds and gold keeps climbing, it creates this really powerful knock-on effect, which brings us to an opportunity a lot of people miss: the companies that actually pull the gold out of the ground. We're talking about the gold miners. So let me show you why this is such a big deal. It all comes down to something called operational leverage. Just look at this simple example. Say gold goes from $2,000 to $3,000 an ounce. That's a 50% jump, right? But for the miner, whose costs are pretty much fixed at, say, $1,900, look at their profit. It explodes from $100 an ounce to $1,100. That's a 10x increase from a 50% move in gold. That's just incredible leverage. But you know, when you really zoom out and look at the big picture, this isn't just a story about a shiny metal. It's a story about something much, much more fundamental. It's a story about the one thing that holds the entire global financial system together: plain old confidence.
And that's really the heart of the matter. Gold isn't moving because people suddenly want more jewelry. It's moving because it's a symptom. It's a signal that the trust in the old way of doing things, the old framework, is starting to crack. Gold is simply the barometer for that confidence.
And all of this leaves us with one last really big question. This whole framework suggests we're shifting from a world where trust in the financial system was just assumed to a world where it's being questioned and reevaluated in real time. So the ultimate question isn't just where the price of gold is going, it's what happens when the entire world starts to reprice the very concept of trust itself.